What does stock market correction territory actually look like? Watch this, here's a real 2026 example and what investors did next. By the end of this video, you'll know exactly how to spot a market correction, use free tools to track it, and make a realistic action plan for your own portfolio. 30 Why correction territory matters in 2026. Let's be honest, 2026 has been a roller coaster for investors. We've seen the S&P 500 drop 11.6% from its February high, the Nasdaq down 13% after last quarter's AI sector pullback, and even dividend ETFs weren't immune. If you don't know what a correction is, here's the risk. You might panic sell at the worst moment or miss out on a buying opportunity when fear is high. And if something falls 10%, is that a warning or an opportunity? That's why you need this concept in your investing toolkit today. 130 prerequisites. What you need first, you don't need to be a
professional trader to nail this. All you need is a basic brokerage account like Robinhood, Fidelity, or Vanguard, access to price charts, the free stock app, or Yahoo Finance works, a calm mindset, because corrections are all about psychology. 2200 Step 1. The exact definition of correction territory. First, let's get super clear on definitions, because there's a lot of bad info out there. A market correction happens when a stock, index, or sector drops at least 10% but less than 20% from its most recent high. That's it. Below 10%, that's just a pullback. 10% to 20% correction territory. Over 20%, that's officially a bear market. Here's an example. S&P 500 peaked at 5,320 in mid-February 2026. By April 3rd, it closed at 4,705. That's a 11.6% drop, solidly in correction territory. If you're tracking individual stocks, the same rule. 10% drop from a recent high triggers correction status. 305 Step 2. Real 2026 market examples. Let's pull up some real numbers so you see how this plays out. S&P 500 peaked at 5,320 Feb 2026, dropped to 4,705 April 2026, 11.6%. Nasdaq 100 peaked at 18,500, fell to 16,065, 13. 1% Vanguard dividend appreciation ETF dropped 10.7% from its March 2026 high. AI sector using Global X Robotics ETF down 14% in just 8 weeks. But here's where it gets interesting. Not every 10% drop feels like a classic crisis. The media shouts, social feeds panic, but sometimes corrections resolve fast, other times they turn into grinding downturn. 450 Step 3. How to spot corrections using free tools. Let's break down exactly how you can spot when your stocks or ETFs enter correction territory, using only free apps like Yahoo Finance, Robinhood, or Google Finance. Step 1. Find the most recent highest closing price for your asset. Step 2. Note the most recent LOW closing price. Step 3. Calculate the percentage change. High minus low divided by high times 100. Example, S&P 500 peak at 5,320, low at 4,705. 5,320 minus 4,705 / 5,320 times 100 equals 11.6% drop. Correction territory. Want to make this easier? Most charting tools like TradingView or Yahoo Finance let you use a ruler tool or percentage change overlay. On Google, literally type 5,320 minus 11%, see where the correction line would be. Pattern interrupt. Show Google search bar, typing live calculation. 620 Step 4. What to do during a correction. Okay, you see your ETF or a stock dipping 10% plus. What now? Here's a framework that works in 2026. 1. Revisit your portfolio rules. Are you investing for 5 years or 5 months? 2. Don't panic sell. Data from 1980-2026 shows about 70% of corrections never turn into full bear markets. Most recover in 3-5 months. 3. Look for quality on sale. If you've been eyeing high conviction stocks or ETFs, a correction is often the only time you get them cheap. But only buy what you were already planning to own. No chasing plungers. 4. When in doubt, do nothing. No response is better than panic selling. Here's where it gets interesting. Even in the AI sector, which took a harder hit in March 2026, top funds like Global X Robotics ETF bounced back 8% in less than 35 days after hitting their correction low. Timing panic sells rarely works out. 800 Pro tips to handle volatility. Let's make you correction proof. Here are 3 advanced strategies. Tip 1. Automate your investments. Use dollar cost averaging with a fixed monthly deposit. It forces you to buy more when prices are low, removes emotional decision making. Tip 2. Set alert triggers, not stop losses. Most platforms, Fidelity, Schwab, Webull, now let you set price alerts. When a correction starts, you get a notification, then you act consciously, not reactively. Tip 3. Use sector-weighted diversification. In 2026, tech and AI-heavy indexes got hurt, but consumer staples, healthcare, and some energy ETFs only dipped 3-6%. Shifting even 10% of your allocation can smooth out
those big 10% plus drops. If you're enjoying this, hit subscribe. We post stories like this every day and you don't want to miss the next one. 900 results and next steps. So here's what we built today. You learned what correction territory means in plain English, saw real 2026 examples with exact numbers, ran your own correction check on any stock or ETF, got step-by-step strategies for investing smart. Not scared. If you're serious about building real wealth, understanding and not fearing corrections is essential. Subscribe and hit the bell. We drop new investing and AI-powered money content every single day. The next story is even crazier. We'll show you how to use AI tools to find undervalued stocks automatically right as they enter correction territory. If you like this, watch our next video, AI stock picks, how to beat the 2026 market correction. And remember, none of this is financial advice. Do your own research and stay smart.